Welcome back. You're with us here on Editors Roundtable. Now, the earnings season is underway, and I decided to take a look at a sector where there is across-the-board disappointment. I mean, there are very few sectors this time around where there is across-the-board optimism or across-the-board disappointment in terms of earnings. But there is one, chemicals. It was, in a way, well advertised. It was not as if numbers came as a shock or anything. But just take a look at the companies which have reported so far. This is not an exhaustive list, but I think this gives you a sense of how pervasive the disappointment has been. These are revenue numbers first up, which will come up on your screen. Year-on-year change, starting from Sharda Cropchem, where revenues dropped 23%, and of course they reported a loss at the net level. Atul Limited 20%, Clean Science 20%, UPL reported a 17% drop in revenues, SRF 15%, and so on and so forth. Deepak Nitrite, which reported yesterday 14% as well. So double-digit revenue decline for most of these companies. I mean, actually, the only exception perhaps is Navin Fluorine, where there was a sort of revenue growth. Look at margins and profit after tax numbers as well. And this is all year-on-year change. The compression is huge. Navin Fluorine, 160 basis point compression in margins. SRF was 500 basis point compression in margins. Deepak Nitrite, 550 basis point compression in margins. Look at profit after tax sort of levels as well, the year-on-year change. Again, anything between 5% to 40% decline in terms of profit after tax sort of numbers here. What this has done is it's brought down full year EPS estimates. As UPL is the most, which has seen a 12% downgrade to full year FY24 earnings. Sharda Cropchem, SRF, Atul, I mean, between 2 to 12% is what I'm picking up. A few analysts I spoke to said, well, this is not enough. You need to see more because earnings expectations, consensus Bloomberg earnings expectations are still quite high. The next plate which will come up is basically the fall from all-time highs, peak basically. Clean Science is down 50% from the peak. Name like Sharda Cropchem is down 40%. You got Atul, Deepak Nitrite between 30 and 25%. Dhanuka Agrotech, SRF. The names are up on your screen. The last chart is what is the most interesting. Names like Clean Science at the peak, which is just 2-3 years ago, right? Used to trade at 100 times P, 1 year forward earnings, 100 times. It trades at 40 times earnings now. So huge compression on P multiple. Gujarat Fluorochem is the second biggest compression from 46 times to just under 20 times. UPL has gone from 17 times to 10 times. Deepak Nitrite 36 times to 24 times, and so forth. The point is, it's a commodity. Most of it is a commodity business. If you talk to analysts, if you talk to investors in the space, most want to be with the specialty curve, which is Navin Fluorine, PI Industries, Vinati Organics, etc. Most of the other sort of commodity chemical companies are still largely dependent on bulk commodities, trying to specialize, trying to move up the value curve, and that's where perhaps most find a little more comfort. Just one lesson as well from this, the last plate, especially the P compression. Extrapolation of earnings on Excel sheets is dangerous. I think the clean science numbers kind of more than anything else for me makes that point. Mir, what do you make of it, the chemical space, and are you interested?
Interested, yes, because this is one sector which will show consistent volume growth for the next few years.
Yeah.
So I don't think anybody is going to doubt that. The last couple of years or last 3 years saw multiple tailwinds. We got volume expansion, we got price expansion, and when that happens in a continuous fashion, you get inventory gains also. So obviously with China coming back on stream and some of the global supply bottlenecks which happened during COVID going back, we are seeing supply coming back in a lot of these chemicals, and hence the price correction. And we are seeing the other side of the inventory drawdown. So there are some inventory losses and there are margin compressions. But I don't think the story is over. The China plus one, the India as a manufacturing hub, and our strengths in chemicals still continue. And most of the companies that you talked about are looking at anywhere between 15 to 25% volume growth for the next few years. So I don't think that's anything to worry about in the longer term. And as you rightly mentioned, valuations have come down very sharply. So it's not a bad thing to look at.
Okay, well, we have run out of time on the show, but thanks a lot, Mihir, for joining us here in the studio. Have a great weekend.
You too.
And to you viewers as well, have a great weekend. We'll see you again on Monday.